Good afternoon. This is the House Judiciary Committee. Today is January 27, 2026, and we are going to start with a briefing from, we're going to start with the Maryland Insurance Administration. If you all want to come on up and begin, that would be great. And you will need to press the mic, I believe, to get us started.
Can I?
Okay, it's good. No, you're good now.
Yeah, let me,
You're good.
she's good?
Yep, as long as you're using that mic with the red light on it.
Okay.
Here, Maria.
Okay, maybe not. Can we
Let's
get
try
rid of the
that
other
one.
one?
How about that one?
Maryland
Oh,
Administration.
this one doesn't work. It's okay. If
All right.
you
Let me
can
move this
maybe
again.
your-
Yeah, let me move this more. Teamwork is the dream work. Here we go.
Right.
So do we have members of the Maryland Insurance Administration here today?
Yes, Madam Chair, my name's Marie Grant, and I'm the Maryland Insurance Commissioner.
Okay, great. Thank you.
Yeah. So, thank you, Madam Chair, Madam Vice Chair, committee members, Marie Grant, again, Maryland Insurance Commissioner. It's really wonderful to be here with all of you and talk to you all a little bit. Our plan today is to give you an overview of who we are and what we do, particularly in the property and casualty space. Thank you so much. And particularly, I think some of the most critical issues that I'm keeping an eye on, I'm sure you are too, are affordability and availability of homeowners insurance and availability and affordability of personal passenger auto insurance. So look forward to diving into some of those topics with you and really look forward to working with you all as a committee. Let me just say too, and I think our deputy commissioner is still snowed in. I think she's joined us by Zoom link. So I'll do the bulk of the presentation, but our deputy commissioner, Joy Hatchett, who's also in our acting associate commissioner of property and casualty role right now, has significant depth of experience at the MIA. So I may field some questions to her. We'll
Okay,
see.
that's great. No problem.
All right, great. So first of all, just again, a little bit about us. We're an independent agency that regulates insurance in Maryland. We are small but mighty. We're with a little less than 300 employees. We regulate an approximately $50 billion industry in Maryland. What that looks like is we license insurers to do business in the state, as well as producers and other insurance-related entities. And when I say producer, that's the term in law. You may know them as brokers. We examine the business practices of our licensees and insurers to ensure that they are complying with Maryland law and regulations. We monitor the solvency of insurers. I know we don't often think about insurance companies as needing money, but actually that's a cornerstone of what we do. We want to make sure that insurance companies can pay out the benefits to their subscribers that they've promised to them in a contract. And so we have a financial regulation unit that's actually what we get accredited for with the National Association of Insurance Commissioners is our ability to regulate solvency and to solve problems as they arise and have orderly wind downs from companies if they do eventually go insolvent. We review and approve insurance policy forms. We review insurance rates, and we're going to talk about this a little bit more in the property and casualty space to ensure they are not inadequate, excessive, or unfairly discriminatory. We investigate consumer and provider complaints and allegations of fraud, and we have a number of consumer resources that I would encourage you all to take a look at. We can also come to constituent events. We do a lot of activities out in the community, and so I just want you to know that that's a resource we can provide to you all as well. And then finally, we serve as a second responder in the wake of natural disasters. in the state. For example, I think what we're going through this weekend and this week, we actually work very closely with MDEM. We put out communications to consumers, and to the extent that you're hearing from your constituents about issues they are having with filing homeowners complaints, we really want you to reach out to us. We are happy to help with any of those issues. Okay. So how are we funded? We are a self-funded agency. We do not use general fund dollars. We are funded purely through assessments on the industry. We have two separate funds, our insurance regulation fund, and we also have a healthcare regulatory fund that supports some specific healthcare related consumer work. We are a general fund contributor. So we collect premium taxes from insurers. They're not subject to state income tax, but they are subject to a premium tax. In fiscal year 25, that number was close to $800 million that we collected. Okay. So I'm going to give a little bit of an overview of the several types of property and casualty insurance that we regulate, particularly in relation to what we call personal lines, which is insurance that you or I might purchase on behalf of ourselves. So we regulate several types of property and casualty insurance in the state: homeowners, motor vehicle, commercial and professional liability, pet insurance, and travel insurance. So I come from a healthcare background where we regulate rates charged to health insurance companies very closely. Property and casualty rates by law, by design, are not regulated as closely. So we do have actuaries that review filings, but the standard of review for rates in P&C at the MIA is file and use. So what that means is that an insurer has the right to file their rates with us and then go sell that in the market. I want to tell you that that's actually not what they usually do. They typically like to have a regulatory seal of approval, and we do review the rates, again, those standards, to make sure that they are not excessive, inadequate, or unfairly discriminatory. But it is a much higher bar that we're looking at versus what we see in health insurance. These are, and the reason behind that is that these are competitive markets. I think the philosophy is that because there's competitive rating, that there's plenty of incentive for insurers to get down to the lowest price that they can offer insurers. So I want to talk a little bit about homeowners insurance. Homeowners insurance is there to help consumers manage the financial risks of home ownership. It can help consumers recover financially following a covered loss to their house, to the personal property in their house, or other structures on the property. It can also help protect consumers financially if someone is hurt on their property, or their property is damaged because of something the insured did or something that happens on their property, by providing liability coverage and or paying for medical payments. So this slide outlines what are generally the basic parts of a homeowner's insurance policy. Generally, they include dwelling coverage, other structures coverage, personal property or contents coverage, additional living expenses coverage, that is a policy may pay for additional normal and customary living expenses you incur when you cannot live in your home because of a covered loss. So for example, if you have a fire in your house, you can't be there. Oftentimes living expenses up to a certain point might be covered by your policy. Liability coverage and medical payments coverage. It's also important to know what homeowners insurance policies typically don't cover. They typically exclude losses due to flood, mudslide, earth movement, or groundwater seepage. And so you can obtain coverage for these types of losses via endorsements to your homeowner's policy or standalone policies, such as through the National Flood Insurance Program, which I'll talk about in a little more detail in a future slide. Okay, so some terminology that I think will be coming up, at least as a part of some departmental legislation we're submitting, and just in general. I want to talk about actual cash value versus replacement cost value in the homeowner setting. So essentially, these terms describe how the amount paid to settle a claim covered under a property insurance policy is determined. So if the policy contains replacement cost value settlement terms, the settlement amount would be the full amount needed to repair or replace the damaged or destroyed property, subject to whatever coverage limits might be under the policy. If the policy contains actual cash value settlement terms, the settle amount is the amount needed to repair or replace the damaged or destroyed property minus depreciation over time to reflect the decline in the value of the property due to things like wear and tear, deterioration, or just obsolescence. Some other key terms: first party, which is direct damage to your things, or third party, which might be liability to others. Perils is essentially the cause of the loss. Deductible, the amount the insured pays out of pocket before the insurance kicks in. Limits, the maximum amount an insurer will pay for a covered loss. Premiums are the cost of the policy, and in homeowners, that's usually assessed once a year. And then subrogation, which is the process where the insurer pursues a third party at fault to recover claims costs. I'm going to talk a little bit about other types of residential property insurance. First of all, renter's insurance. This is a really valuable product. It's something we really try to encourage that folks have awareness about. A landlord on properties typically carries insurance that covers structural damage to a building and potentially covers damage caused by a tenant. But what they don't typically cover is things like damage to the tenant's personal property. They don't protect the tenant against liability for any damage they cause to the building. And they don't typically protect the tenant against liability for an injury that a guest sustains on the leased premises. So that's where renter's insurance can step in and is really important. Condominium insurance, and I think we've had a few bills in recent years, and you all may have even heard from constituents around some challenges in this space. So in a condominium situation, typically there is a master policy that the condominium association holds to protect against losses and liabilities, and it covers property damage to the common areas, liability for accidents, and structural damage to individual units. And then there's the unit owner's policy, which is a type of homeowner's insurance plan specifically tailored for condominium owners, and it covers interior property damage, personal belongings, and liability for accidents within the unit. So I think what we sometimes hear about is concerns about the different levels of coverages, where there might be a dispute between who covers the damage in the condominium association. And if you all have a particular interest in that issue, happy to talk more in detail about that. Okay, the last thing I'm going to talk about with homeowners for right now is that there is what we call an insurer of last resort, or a residual market mechanism in homeowners insurance in Maryland. It's very small. You may not have heard of it. To be fully honest, I hadn't heard of it until I took on this role. It's called the Maryland Joint Insurance Association, or the JIA. And what that is, it's an incorporated association of all insurers licensed to write essential property insurance in our state. It's established under the insurance article. And its purpose is to make essential property insurance available to folks who are unable to obtain it through the voluntary market. And the coverage in some cases may be more restrictive. The JIA doesn't receive or contribute to state funds. Each JIA member, which is essentially our homeowners market, shares in the expenses of running the pool, shares in profits and losses in proportion to its share of aggregate written premium in our voluntary market, which is most of our market. As of September 1 this year, there were approximately 760 JIA policies in force. So really tiny market. And again, it's really for folks who for underwriting reasons or otherwise can't get homeowners insurance in other ways. And as with standard homeowners insurance, these policies don't cover losses from flood. All right. So I'm gonna turn to private passenger auto or just auto insurance. So every person who owns a vehicle registered in our state is required to purchase automobile insurance coverage that meets the minimum coverage limits for bodily injury, property damage, and uninsured motorist coverage set forth in Maryland law. So for bodily injury liability, we have coverages of $30,000 per person and up to $60,000 per accident. For property damage liability, there's a minimum of coverage of $15,000 and also uninsured motorist coverage. Types of mandatory coverages, so bodily injury liability essentially protects you if the driver of your vehicle causes an accident and an injured person makes a claim or files against you. Property damage is of course the actual impact on the property in the car. And then uninsured motorist coverage protects you in the event that an accident caused by a driver is caused by a driver who can't be identified, is uninsured, or is underinsured. That is, doesn't have the full ability under their policy to cover the damage to your property. So while state law establishes the minimum required levels of liability coverage, I want to just pause here and say our liability coverage limits for some folks who may have been in an accident where they ran into mandatory minimums, it may not be enough. But in general, we have some of the higher mandatory liability limits among states. But even with those minimums, most people buy up. So a policyholder can choose to purchase higher limits of coverage to protect their assets in the event they cause an accident that results in significant injuries or damage. So there is such a thing as personal injury protection coverage associated with an auto insurance policy. It provides reimbursement for reasonable and necessary medical expenses and lost wages resulting from an accident, regardless of who caused the accident. We don't require drivers to carry this coverage, but insurers have to make the offer to their policyholders. And additional and supplemental coverages that consumers may opt to purchase include things like physical damage, collision, comprehensive, medical payments, rental reimbursement, transportation expense, towing and labor, and enhanced underinsured motorist coverage. So in property and casualty insurance, in general, unless there's a prohibited factor that is prohibited under law, insurers do their best to look at the risk of a person or an entity, and they can look at a lot of different factors. So again, I come from a health background, and in our ACA markets, we don't rate on any factors except for age. In P&C, that's different. They're really looking at trying to focus in on the risk of the person or the entity that they're insuring. So they can and do look at things like the age of the driver, subject to certain limitations, gender, marital status, number of miles driven annually, driving record, the purpose for which the vehicle is being driven for, the location of where the vehicle is garaged or stays overnight, driving experience, and in Maryland, on initial writing only, credit history, subject to some important conditions and parameters that are laid out in law. So a few more details about credit history and how it can be used under Maryland law in the private passenger auto market. So insurers can't use a consumer's credit history to decide whether they will insure the individual, cancel them, renew them, or increase their premium. However, they can use their credit history when they initially apply for coverage, determine what rate they will be paying for their auto insurance, so on that initial level. It's important to know that not all insurers in Maryland use credit history, and Marylanders have options where they can obtain auto insurance through insurers that do not use credit. For those insurers that do use credit, they're required to tell consumers at the time they apply for insurance that they will consider credit history. All right, so auto rates in Maryland are among the highest in the country. I think different sources say different things. I think I like to rely on the National Association of Insurance Commissioners. I think we're in the number 5 to 7 range the last time I looked. Some places, though, when they're looking at us, they're number 1, but they're up there. And there's all kinds of reasons for that. I think the congestion on our roads, people's commuting distance, the conditions of our roads, there's a lot that plays into that. So this is a little bit of information about the types of rate increases that consumers or all of us may experience from our auto insurance companies. So a general rate increase, sometimes the premiums collected by insurers may not be enough to support the projected costs of claims. And when this occurs, an insurer can file with us a request for a general rate increase. And then there's policyholder specific rate increase. So for example, if a policyholder receives a ticket, gets involved in an accident, they may see a rate increase that's specific to their risk on renewal of their policy. And then another thing in auto insurance that we see is loss of discounts. And while that might not be a traditional rate increase, the loss of a discount, such as an accident-free discount that you could see on your policy, could in effect lead to a higher premium. That is, operate as a premium increase for consumers at their next renewal cycle. We really do encourage consumers to shop, comparison shop, look at their options. We have a great auto rate guide on our website and a lot of consumer-friendly materials that we can offer folks who are looking for the best ways to shop. So our auto market has a residual market mechanism as well. It's Maryland Auto, or MEIF, I think is the long-term name by which we've known them. They're a quasi-governmental agency established under Maryland law that provides auto insurance to high-risk drivers who are unable to obtain coverage through the private market. And as of the end of this year, there are approximately 32,000 Maryland auto policies in force. That is about a drop of close to 30% in the past year. But that reflects, we think, some changing dynamics in the auto market. Over the past year, we've seen rate increases level off from the post-pandemic world. We've even seen significant rate decreases from some of our major auto carriers, and they've also, we think, relaxed some of their underwriting restrictions. So we think at least a portion of that drop is due to some of those changing practices of the private market. So when Maryland Auto's year-end surplus drops below a threshold that's calculated, again, pursuant to law, it accesses funding to ensure its solvency through an assessment on the private market. That's calculated via market share. And then private insurers can decide what they do with that assessment. They can decide to just absorb it. But what they end up usually doing is passing that on to consumers in the form of a fee. There is a specification in law for how insurers need to communicate passing on that assessment. We did have an assessment last year for the first time, I think, in close to 40 years. We anticipate one again this year. And I think the way finances are looking, it looks like we can anticipate another one without any other action next year as well. So this is a little bit more information about why that is, why we're seeing assessments. I think over the past several years, Maryland Auto's surplus has steadily eroded, primarily due to rate inadequacies. I think as we saw a big jump in risk that was coming to Maryland Auto, the rates Maryland Auto is charging, particularly in places where it uses an affordability index to cap the rates, may not be meeting the risk that's in the market. So Maryland Auto is regulated by us. Its rates are subject to review in certain circumstances. And there was legislation that was passed last year that requires Maryland Auto to build up and maintain a minimum surplus level and gives the MAA some greater authority over rates, with the goal being to avoid perpetual rate inadequacies that shift costs to drivers insured on the private market. So I think this will be a topic you all hear more about this session. There's lots of policy decisions in here, and we'd be happy to talk to you about it further. I think there's, again, it becomes a balance between the solvency or adequacy for Maryland Auto, the rates our consumers are exposed to when they're enrolled in that program, and then the passing on of those costs to other consumers. Okay, so a few hot topics. We're closely monitoring the homeowners market. So in other states, you may have read in the news, some other states, particularly those that have seen some big storms, wildfires, challenges. There's concerns about accessibility in those markets and competitiveness. I mentioned our little teeny residual market in this space, the JIA. In some states, the FAIR plan, which is their residual market mechanism, like California, for example, is actually the biggest homeowner insurer in the market because of some of those market dynamics. So we have a really positive, competitive, relatively affordable market in homeowners, but we are trying to make sure it stays that way. So we're closely monitoring dynamics. We are seeing evidence that carriers are tightening their underwriting standards, and we're asking them for some more details about how they're using underwriting. So, Madam Chair, happy to stop or keep going, whatever you prefer.
I think we're going to, in the interest of time, we're going to ask you to stop here. I see 32 slides, is that right? And we're on 18?
I think we're actually on 23. The rest of the deck is about a few more hot topics and also just information on how to contact us.
Okay. Okay, good. Well,
Yeah.
that's good. Did you have anything that you really wanted to tell us that you didn't get out?
Just really look forward to working with you all. Happy to talk about any of these issues. Myself and my team are available here for you and look forward to working with you.
Well, great. Well, thank you for being here. We're going to have questions probably.
Okay.
I have just one question. Sorry about that. you mentioned right at the end, you were saying that the insurance industry would, put it this way, let me ask my question. Is there transparency as to rate determinants? And if there is that something that comes to you all, or is that somewhere, can you talk a little bit about that transparency?
Yeah, so insurers do file their rates with us, and they submit rate filings that contain justification for those rates. So in that sense, we have pretty good insight into what they're doing. We also, as an agency, have the ability under law to, some pretty powerful ability to ask questions and get answers from our licensees. That all being said, one of the things that we're going to be moving forward with is regulations that require insurers to file personal home and personal auto underwriting guidelines with us, because that is, it's in P&C, it's not just the rate, it's who is getting written for the rate as well. And so that's, we're taking steps to get more transparency into the market.
Okay, great. And also, if you could supply a little bit more information with respect to how zip codes are used?
Yeah, absolutely. So in auto, or generally?
Auto for right now. Well, actually generally, but I'm particularly interested in auto.
Okay, great. So in auto, our insurers often use territorial ratings. So one of the things that they are looking at when they are writing a risk is what is happening, the accident experience, loss experience in the area in which they're writing. And most carriers do that through zip code, looking at territories at zip code. So we did have an auto affordability work group that met over the course of this fall. More detail in those remaining slides. Territorial rating was something we looked at. There wasn't consensus on what to do next, but I will say, as a regulator, my interest is making sure that territorial rating is not being conducted in an unfairly discriminatory manner, right? So just because the work group didn't come to consensus on those issues doesn't mean that we as regulators aren't going to continue to look into that issue really closely.
Great, thank you, I appreciate that. Members, do you have questions? I'm gonna start on this side and just work my way around.
Yeah.
Delegate Phillips? Delegate Simmons, I'm sorry, I didn't see your light there. Do you mind, Delegate Phillips? Okay, Delegate Simmons?
Thank you, Madam Chair. Thank you, and thank you for coming. Exciting information. So when we look at the state of Maryland, I think one of the biggest things about affordability and how we're making things affordable for the residents that stay here, including ourselves. When you look at where do we compare to other states, so two things here. Where do we compare and where are we trending? Are we trending up or down in the sense of what we're trying to do to make our state better when it comes to these rates? And number two, do you see any disparities in the insurance industry that has an adverse effect on the state of Maryland?
Yeah. Those are great questions. I think the first one, I think for homeowners, again, we're relatively competitive, relatively affordable. Not sure that from the data I'm seeing, our rates are out of line with what other states have. It's in auto, though, that's different, right? We're definitely among the highest, or the states with the highest rates. It's been that way, I think, for decades. And I think just, again, based on some of the conditions that we've seen in the states. And then over the past 5 years, so if you'll recall, during the COVID-19 pandemic, folks weren't on the road. There was a pretty positive experience for auto insurers. The rates plummeted, big discounts, sometimes rebates were given. But then folks got back on the road and accidents started happening and rates climbed through about 2024. Now, that's consistent with experience in the rest of the nation. That's not unique to Maryland. Of course, we were starting from a higher place, but that climb and what folks were seeing is something I see around the country. In 2025, it's clear from what we've seen in our filings that we're leveling off and even coming down. So that's good news. But I think part of that affordability look that we did this fall is to look at some of the things driving the high cost of our auto insurance. What are the things that can be done? Some of them I think we're taking a closer look at, and we have some ideas on what I as a regulator can do. But some of them are much bigger issues, right? Things like transportation funding, things like that. So bigger societal issues than my little agency can control. I think in terms of discrimination cases with insurance companies, that's something we take very seriously, that we investigate very closely. I can't talk specifically about some of the cases that we're investigating, but certainly that is something we get complaints about quite a bit.
Sure, in the interest of time, I'll follow up
Okay.
with you.
Yeah, I would
on
love
any
to
further
follow up.
questions. Thank you.
Yeah.
Great, thank you, Delegate Simmons. Delegate Phillips.
Thank you. Thank you, Madam Chair. A couple of questions. One, dealing with using geography or zip codes. In that study or in that review that you've had with industry, have you talked about, because it seems to me it gets to be a little unfair, particularly in dense populated areas, right? And often the persons who are involved in accidents, perhaps particularly around auto insurance, may not be the persons that live in that particular zip code. Do they disaggregate, and is that part of that conversation, or is it all about where you live?
That is something we're actually looking into, Delegate. So again, we didn't come to a consensus on ways to handle it. So I will say most states, I think, allow auto insurers to sort of set their territories. They have to be actuarially justified, but they allow them to set their territories. Some, as we discussed in our work group this fall, take a closer look and have higher standards in law for how you have to justify those territories to your regulator. And then at least one state that we're aware of, Connecticut, actually has a required mix of statewide experience versus the experience in the town you live in. So all of those, again, we couldn't come to consensus on an issue, but there are things that we are looking into, I think, first of all, making sure we understand what's in our filings on this issue, but second of all, continuing to explore other options, because I know it's of concern.
Have there been, since property and casualty is new to us, have there been initiatives from the legislature to kind of assist and push us into one way or the other and trying to stabilize rates and ensure that certain communities are not feeling the brunt?
Yeah. So, I started in this role in October of 2024. The creation of that work group was a legislative creation. The report's a legislative report. I think that report is intended to start and keep that conversation going. It's not intended to be the end of a conversation.
And then one other question, Madam Chair, and it really has to do with the Maryland Auto Insurance Fund. And this idea, as I understand it, there's been conversation about it becoming fully rate adequate, if you will. I think that's the language. It seems to me that would increase rates with MAIF considerably. Can you talk to us about how that would work?
Yeah. So, going back to this inadequate, excessive, unfairly discriminatory, those are the standards we look at rates. And I think without looking at other items, I think MAIF has historically argued that affordability should be taken into account because they are the insurer of last resort. And I think historically and respectfully, I think we just have a disagreement there about what is in Maryland law, right? MAIF is subject to the rate-making standards that are in.
Say it again, I'm sorry,
The rate-making standards that are in our insurance article. And so December of 2024, we issued an order to MAIF that said they couldn't use the affordability index or CAP, and that they needed to phase it out over time. They asked for extra time to do that in March. We granted that to them. And they've asked for extra time again, and we're reviewing that request. I think you're hitting the nail exactly on the head where again, there is what is in Maryland law, and then there's the questions that you all have to grapple with, right? Which is, I think from where I sit as a regulator, MAIF's rates are required to be adequate and should be adequate. But I think you're raising concerns about if they are adequate, what is the impact for those high-risk folks who may not be able to afford that important coverage? And I think that's the discussion we continue to have with Maryland Auto.
Okay, I get concerned about that because now people say, well, why are people going to Virginia to get, right? There are reasons,
Yeah.
right? If we make it to the place where people can't afford their insurance, they're going to go wherever they can to have cars titled because we're a state that requires people to have cars.
Right. And as a policy matter, a delegate, absolutely. But I think that would be something that that would be important to really spell out clearly in law, and that B, everyone would need to be comfortable with. That would mean MAIF would continue to run at a loss, and we would assess other drivers for that.
Okay. Thank you.
All right, thank you, Delegate Phillips. Delegate Cardin.
Thank you, Madam Chair. Thank you for being here. If somebody can't afford the insurance here, can they go to Virginia and get insurance on their automobile if they're a Maryland resident?
That is not, this is, it's not legal to.
It's not legal. I just want to make sure.
It's not legal.
Okay,
It's
but they
not
do
legal.
it, right?
They do it, and they do it in part because Virginia had a option for folks to buy a special kind of license where they didn't have to have insurance. And so I think that's when we saw folks took advantage of that option. I think we saw proliferation of Virginia license plates. I live in Baltimore County, but just over the city line. My kids' school parking lot was suddenly had more Virginia license plates than I think I was confused about that. But it's not been legal. Virginia has closed the loophole in their law. I think there continues to be an issue of folks who are driving with out-of-state license plates and not carrying the required insurance under Maryland law.
And just to follow up, that and the fact that there are a proliferation of people driving without any insurance at all is causing some of the problems with the fund not being full. Is that
Yeah.
fair to say?
Yeah, so it is, again, a requirement to purchase auto coverage to be a driver in Maryland. There's a really significant penalty if you do not comply with that requirement. But one of the recommendations that came out from our auto affordability work group was to look at a low-cost auto option. So I just want to reiterate, Maryland Auto is designed to be for those higher risk drivers. You need to actually be turned down by 2 auto insurers before you join Maryland Auto. But we're all, I think, acutely sensitive to the affordability challenges that Marylanders are facing. There are a handful of states that have certain types of skinny plans or other programs for low-income folks specifically that they can qualify for, and we're want to continue to do that work. I think you'll see a departmental bill on that topic.
Thank you. And then just finally, not to answer this now, but you did have 2 slides, one on childcare liability insurance and medical liability insurance. And perhaps you can follow up with me because I just want to make sure we're not missing anything because we missed those slides. But
Absolutely. I think those are just areas we're closely monitoring, and happy to talk to you further.
No. The Vice Chair?
Thank you, Madam Chair. I have another question regarding risk factors.
Yeah.
Are you regulating them or do individual insurers determine what risk factors they use?
So individual insurers file with us on what they build into rates and risk. We review those filings to make sure that they're not discriminatory based on Maryland law for any number of prohibited factors.
All right. Do you have any documentation that credit report is directly related to your risk of having an accident?
So I think this is, and I know Deputy Commissioner Hatchett, if she's still on the line, may be able to follow up with this further. In homeowners insurance, we prohibit rating on credit. In auto insurance, I think the industry has argued for a long time that there is a link between credit and risk. And so the current state of Maryland law about private passenger auto, I think is a compromise that was essentially passed in I think 2015, where credit can be used in a limited way on initial writing and not renewal. Vice Chair Davis, I think it might be a broader conversation offline about whether that's actually tied to risk, but I would love to talk to you more about that.
And actually, it was the legislature who decided that
Yeah.
you were no longer going to be able to use credit
No
rating
longer
for-
in homeowners,
for
yeah.
homeowners
And the
policy.
compromise for auto, yeah.
Okay, thank you.
Delegate Williams?
Thank you, Madam Chair. I wanted to go back near the end of your testimony. You were talking about the personal home rates and that you guys are doing, I guess, a deeper investigation of that.
Yeah, so I think what I was talking about was we're monitoring availability of homeowners insurance. We're seeing broad availability, but we are seeing what we call indications of a hardening market, where there may be cases, for example, on the coastline, where insurers are increasingly using underwriting guidelines to not write risk on places like the coastline. We've also seen a jump in proportion, still relatively small, of non-renewals. And again, so this is a market that we work with our National Association to collect data on specific to Maryland. We're moving forward with collection of underwriting guidelines. It's really a market we're keeping a close eye on.
Okay. And with that examination, are you also including condo insurance, whether it's individual policies and/or master policies?
So I think the bulk of our focus has been homeowners specifically, but would be happy to talk to you more about issues you're seeing with condo insurance.
Yeah, I'd love to. When I live in a condominium,
Yeah.
and so I'm happy to have a conversation about what's going on in the condo insurance market and how that's driving up condo fees. So thank you.
Absolutely.
Delegate Conaway?
Chair, thank you for coming in and giving us this presentation. Who sells the JIA?
It is a consortium of insurers that have formed a board and a separate corporate entity.
So,
So it's a private entity,
So a
essentially.
consumer would just contact their local broker or something like that?
Yes, and usually, and if you're having any consumers that are struggling with insurance on the market, do let us know. But yes, they should be able to get to them through their
Okay,
broker.
do you know what the limits are?
Not off the top of my head, but we can get them to you.
Okay, and property values now in the casualty is 15,000 for automobile? That's the minimum?
Yes, yep. let
And
me-
what's the average loss come out to be?
I don't have that number at the tip of my fingertips. Perhaps our industry partners do.
You could
but
get that
yeah.
back to me.
Yeah, but it is going up,
Yes,
sir.
I understand
Yeah.
with Teslas and things like
Yeah,
that.
yeah.
So what percentage of the auto insurance drop / surcharge is due to the out-of-state tags?
We don't know that.
You don't have a
We
hard
don't
number on
know
that
that. We
yet?
don't have a
All
hard
right.
number.
Thank you so very much.
Thank you.
And let's now hear from our Property and Casualty Subcommittee Chair, Delegate Taylor.
Am I last? Okay, that's great. First of all, thank you for being here today. We've had several conversations leading to this briefing, and I know we'll spend a lot of time together. Thank you to my colleagues on Judiciary, because, I actually wanted to be last because I knew you would ask all the right questions about affordability versus adequacy, the JIA, zip code concerns that we have, credit scores versus credit scores and credit history and how they play into our rates. One question there is, do we have a list of those companies that we know are using credit scores and credit rates for their, credit history in their rates? I wonder if we know that.
Not off the top of my head, but I think we can get back to you with that
I'm sure.
information, yeah.
And then one thing we haven't talked about, but I know we will, is telematics.
Yes.
And how they factor into either discounts or rates, or maybe you can touch on that a little bit. And
Yeah.
finally, just look forward again to working with all of you.
Oh, thank you so much.
And
Well,
hi,
really-
Nancy. Hi, Nancy, as a shout out.
Thanks so much, Delegate Taylor. Really look forward to working with you as well and the subcommittee. So telematics is essentially a term for usage-based insurance, where in auto insurance, there is something that is monitoring your driving behavior and calculating a risk and a rate based on that behavior. So in the case of a Tesla and Tesla insurance, that might be your whole car that's monitoring you. Other insurers use things like an app or a plugin. We did a report and a survey of our auto insurers to understand a little bit better the experience of folks who are in these programs, and then what kinds of things they were rating on. I think about 30% of folks saw a decrease. 20% of folks saw an increase. Thanks. And but most folks enrolled, or I think about 45%, saw no change in their rates. And there's quite a bit of data and variability in the data that's collected. I think going back to some of our conversations with risk, these are a growing product that's available in the market. I think if you're a great driver, it might be something that's good for you, but I think we're interested in making sure that there's adequate disclosures to consumers about what they're signing up for, as well as ensuring that companies are adequately monitoring how they are measuring the risk and updating these models. So, thank you.
Thank you. And members, if you go to your slide 23, on page 23, you can get more information on telematics. Thank you so much for being here. This has been quite an informative briefing, and I'm sure we will all be in touch with you if we have any concerns beyond what you discussed today.
Thank you so much, Madam Chair. Thank you.
Now we're going to bring up members from the American Property and Casualty Insurance Association. And I believe, well, I can't ask Hunter my question confidentially, so I'll just wait and go ahead and give Nancy a moment to get all set up.
And I've never done this PowerPoint in front of you all before, so I'm not the best.
Press this button to go forward.
Thank you. Hold on just 1 second while I get my
Yes,
presentation.
take a moment to get yourself settled in.
Thank you. Okey-doke. Okay, let me see if I can figure this all out, and I apologize.
No worries. So, Ms. Egan, I just wanted to let you know, we're gonna hear, and members, we're gonna hear from American Property and Casualty Insurance Association with Ms. Nancy Egan for 15 minutes, and then we can take questions, and then we'll hear from the National Association of Mutual Insurance Companies for 15 minutes, and you'll have an opportunity to ask questions. Okay, Ms. Egan.
I keep using the wrong remote here, sorry, thank you. Okay, first of all, good afternoon, everyone. My name is Nancy Egan. I'm with the American Property Casualty Insurance Association, otherwise known as APCIA, because you'll hear that acronym a lot. I know I have testified in front of you before on some liability issues, such as the non-economic damage caps, which is coming back again this year. But for those members that are new, I just want to introduce myself and just give you some background because I think I am an insurance geek, and I will admit it. And if you go to a cocktail party and you say I'm in the insurance industry, people walk away. So I'm going to start right there. I grew up in a family. My parents owned an insurance agency located at York and Bologna in Baltimore City. I grew up with the whole insurance industry. I left and went off to college and came back to work for my dad and my mom, and my grandmother worked there, and I had cousins who worked there, so it was a big family industry. So we sold our agency in 2007 to an agency down in Severna Park called Moran Insurance, and I was there with the transition for several years. And then I decided it was time for me to pursue other areas. I had gotten my law degree at night in my 30s. I actually attended night law school with Delegate Davis, but I never used my law degree. And after we sold our agency, I went to work for the Maryland Insurance Administration, not under this commissioner, but under previous commissioners. And I was there for several years in the commissioner's office doing state government relations. And later on, after a period of time, I was hired away by APCIA. So I welcome you to ask me lots of questions. I know you had a lot of questions already, and I think that I have a background where you can ask me some of the questions you've already asked before. So let me just give you a detail of APCIA. Do I do this? Sorry. No. Okay, there's the click.
Oh, no.
I told you I wasn't good at this. One more above that. Thank you. Sorry. So APCIA, obviously we're the largest trade association in the United States. We write about 2/3 of the insurance. You can see on the slide, US property casualty insurance, a trillion annual premiums in the United States. That's about 1/3 of all premiums written in the world. 450,000 people employed, 1.3 million agents, brokers, producers in the US. And it's extremely competitive. There's 3,332 property and casualty insurers operating in the US. 996 are operating in Maryland. And you're saying, what? But they don't all write the same thing. So there's some that are just writing auto, some that just writing workman's comp, some that may only insure jewelry. There's just a whole variety of insurers out there that write different products that are operating in the state. Maryland specific, there's 19 property and casualty insureds that are domiciled here. 35 have headquarters here, 6,000 jobs, and $850 million in premium tax are paid to the state. So what is insurance? I think you need to think about insurance in a different way than you think about other products. You pay insurance companies a premium to get rid of a risk that you're concerned about. You can change how much you want that risk or not. You raise your deductibles because you think, hey, for my homeowners, I can handle fixing something on my property less than $1,000. Or you might say, hey, I'm going to raise my deductible up to $5,000 because that way I know I'm going to pay a lot less for my homeowner's insurance, but I'll put money aside in case I have a loss that is a smaller loss. So what it is that insurance is different. We don't price our product based on the price of eggs. You buy your grocery store, you buy the price of eggs at $1.05 wholesale, and then you sell it, the jumbo eggs at $4.50, which I'm sure you've all seen over the last couple of years. We base our price on losses. So we look at our previous losses and how much we've paid out on claims, and we're trying to predict what's going to happen in the future. This is a lot different than most concepts on pricing for products. So we're trying to determine in the future what our losses are going to be. And we look at different factors that we use to determine if losses occur. So just think of that. And so what makes up some of the losses that we have? It's medical costs, so whatever we pay out to someone that's injured, repair costs, and then the cost of defense, litigation cost. So it's just a different concept than some of the other industries that are regulated by the state. State regulation, this is something we haven't discussed, but there was a law that was passed in the US back in the 1940s called the McCarran-Ferguson Act. And for those of you who went to law school, you already know this had to do with the Commerce Clause. So what happened is the federal government said that the regulatory authority was with the states for property and casualty and also for health insurance, but not in the same level that you see for property and casualty. And so therefore, and I'm not going to go into detail because the insurance commissioner did such a fabulous job about explaining how she regulates our products. So what are they looking at for us? They're looking at our financials. There's NAIC, National Association of Insurance Commissioners, have model laws about how they're going to look at our income and profit statements, that we have to have certain surpluses and adequacy to be able to pay claims. Certain claims, like auto claims, we might only have a 3-year window where we have to reserve losses. But there's some types of claims where they expect that they're considered like long tail claims. Those claims could last for years before we actually have a claim made. I'll give an example that you've seen here in Maryland. Asbestos was a claim that didn't happen until a long time after it was determined how harmful it was to the people that applied the asbestos or worked in that area. Let's go to the next slide. Sorry. So let's go to homeowner costs. I thought this was a great idea to show you a little house. So I would say that, homeowners insurance makes up about 6.5% of all the costs that you lay out for homeowners insurance. The biggest cost, obviously, is your mortgage payment, utilities, although that might be growing, and that, property taxes, and then maintenance. But you all are saying that you're seeing your homeowners premiums go up. Obviously, you are very aware that weather events across the United States have become more and more severe. You're seeing tornadoes in areas that were never having tornadoes before, and Maryland being a coastal area, that the chances of hurricanes have actually increased, and the commissioner talked about properties that are on the coast. But the other thing is rising repair costs. Due to inflation, I know general inflation trends are starting to even off a little bit, depending on the tariff information, but the cost of material and labors to repair and rebuild homes remains very, very high. So as of June 30th, construction material costs rose 44.2%. This is for homeowners. Labor costs for homes rose 38.6%. Now, this is over a 5-year period. Comparing to the rate of premium increases, we were at 23.9. So lots of times our premium increases lag behind what you're seeing in the increases of prices because we have to file our rates with the insurance department when we realize these losses are getting larger and bigger, and it takes a time lag before they're approved and we put them into the marketplace. And of course, Maryland's population is growing. As she indicated, the homeowner's premium has not been profitable either in the United States or in Maryland. Here you're seeing that we're starting to get more profitable, but for the last couple years, over 5 years, oh my God, I forgot to turn the slides. there we go. This was this. This is the homeowner premiums. We're talking about the losses that I just spoke about. And this is looking at what's being paid out and gathered in. So this is showing you that over a 5-year period, for every dollar of premium we collected, we paid out $1 in losses and expenses. The worst was in 2022, where we paid out $1.13 for every dollar of premium we collected. And now with the approval of rates, we've now seen an evening out of the homeowner rates and profitability here in the state. I wanted to just let you know that we are participating in different programs in the United States. One's called the Institute for Business and Home Safety, which has been developed to look at building resiliency standards, such as for wind and fire. You may have seen on the news in Florida, there was a community in the Panhandle that when the hurricane came through, those homes that had the wind-resistant roofs and buildings did not sustain damage while the other homes were flattened. So we are currently, APCIA is doing a tour across the country, meeting with regulators, realtors, lenders, et cetera, to talk about strengthening building codes and talking about improving more resiliency type buildings. Let's go on to auto. Now I'm starting to get the hang of this. I really love this. Average liability premiums, as you can see here, this is the average, about 4.4%. Now that means this is the average between a policy that is either full coverage with high limits, or there could be a policy with minimum limits, but the minimum, the average cost is about 4.4% of owning a car. And this breaks down the different parts of what it costs to own a used car. So I just wanted to give you that little diagram. I think it's really cute, sorry, I just like it. So key cost of auto insurance and why it's going up. Oh, good, thank you. I'm definitely challenged. So this slide is talking about key cost drivers for auto insurance. I know it's a little wonky with all the lines and stuff, but like I said, I'm a geek. So anyway, top auto cost drivers for auto insurance are the value of used cars, which happens when we're trying to total a vehicle, car repairs and auto parts. And car repairs and auto parts are the dotted green lines and the dotted black lines. And all these have escalated higher than the consumer price index, which is the blue line. And then the yellow line is auto premiums, and the red line is commercial auto premiums. So we tend to go behind the other losses. Sorry, lost my page. While general inflation has sort of, like I said, trended off, that doesn't mean that auto price repairs has not. The cost of repairs over the last 5 years have increased 28.4%. That's the labor cost. And I know the MIA is aware, labor cost in Maryland for the people that are repairing your car are one of the highest in the country. So we have a well-paid staff, people that are doing auto repairs in the country, but those go into your auto repairs. The cost of the parts have gone up 44.3% over the last 5 years. Used cars, 33%. And then we look at the time to repair a car. They're actually taking longer to repair your car because the cars are more sophisticated, the parts are more sophisticated. So we look at how long someone rents a car when their car's in the shop. In 2021, it was 13 days. Currently, it's up to 15.5 days. Next slide, sorry. You can skip that, then, just talking about profitability. I just want to go over this slide a little bit. The one side is about auto repair, and we've gone over that. The other thing is medical costs. And some of you that practice in plaintiffs will probably understand this slide better than other people. Medical costs. We do not pay the same rate that you're, excuse me one second. So like I said, the left graph is auto repairs. The other cost is medical payments that we make. So when you get your health insurance bill and they said, you had an MRI, you saw that the cost of the MRI, and I don't know what the pricing is of MRI, let's say it's $1,000. And then your health insurance says, well, our negotiated rate with them is $500. And that's what they pay the doctor. But when the doctor submits their payment and claims to us, we get the bill for $1,000 because we don't have a negotiated rate with the doctor. We're not a health carrier, we're auto insurers, we also provide you general liability. So our rate for what we pay for medical cost is higher than what the trends are for medical cost overall. So the blue line is what we pay out in third-party claims, the other party that gets injured, and the gray line is showing you first-party claims. That means when you're injured, so you can see that they're trending higher than what the CPI average is for medical costs. The next slide is just showing you that, as the commissioner already said, that the auto rates were not doing well originally, and you're starting to see we're starting to make a profit. And then she mentioned that we're actually starting to see rate decreases in 2025. This only goes up to 2024. This next slide is about driving is getting worse. Now, I don't know about you, but after COVID, I think everybody went insane when they got in their car, and I think this slide sort of just tells you exactly the way it is. Speeding has been increased 18%. Distracted driver, how many people have seen people not only on their phones, but putting their makeup on, eating a sandwich, while on the other hand, they have something else? That's distracted driving. And the AA Foundation survey said 96 of drivers admitted to being aggressive in their driving habits over the last year. 92% say they've been speeding excessively or they've been cutting people off. It's nice that it's a blind survey because, you know, nobody's going to say that out loud. So for us, while vehicles are getting safer, it's kind of a race between a smart car and a dumb driver. And for me, the dumb driver is winning right now. So some things about how to save for auto insurance. You know, we want to make sure that we work with every available people. I want to mention, because the commissioner mentioned it, I was the designated person on the task force from the insurance industry, so I can answer questions about that as well. Just some things that we're funding for highway safety. We work with the Insurance Institute for Highway Safety. We invest in infrastructure, and we also work with the National Highway Transport Safety Administration as well. And next slide. Some other ways to reduce costs, enforcement of highway safety laws, which is not occurring as much as happened in the past. Obviously, we worry about tort reform and also reform to lower some costs. The last slide we can just skip because it's just a summary. So I hit my button right on time. Yay!
Great job. Thank you. Thank you. Thank you.
So do you want me to take questions now or wait till?
I'd like for you to take questions now if anyone has any, and it looks like we have two. And Delegate Taylor, do you want to be last again? Okay, Delegate Taylor.
Yeah, thank you, Nancy, for being here and for that presentation. I just have a burning question about deductibles.
Okay.
And, you know, a claim is one thing, and I guess that is the measure of the, you know, the expense, right?
Right.
But when you're calculating the expense in total, do insurance companies take into effect that they are also collecting deductibles in most cases? And is that taken into the bottom line, the fact that they're collecting a deductible to go against an expense potentially?
I'm not so clear on your
So
question.
in other words, if I have a claim and the damage to my car, let's say it's a car claim, is $5,000.
Okay.
But my deductible is $1,000.
Right.
So I have essentially paid $1,000 toward that claim, which
That's correct.
reduces the expense to the insurance company to only $4,000. So what do they report? They report the entire $5,000, or is it just a $4,000 potentially that's reported?
For the amount of the claim that they paid out?
Yeah.
They have to go on their expense, which would be the $4,000. Because they gave you a discounted premium by taking that higher amount, but now they're putting the losses in.
Okay.
Does that explain it? And then if you're in an accident and you've been in an accident and you're not at fault and you have a deductible there, you may have your car repaired in advance because it may be someone that you weren't able to identify right away. The insurance companies have there's a whole subrogation system in place so that carriers can work with each other to subrogate their losses that they've paid out where they were not at fault. I hope that answers.
It does. So you're saying they use the 4, basically not the whole 5.
Exactly.
And most of the, your members of the association, if not all, are publicly held, right?
Yes,
So their financial records are public.
yes.
Okay, thank you.
Delegate Embry?
Is that all right, Madam Chair? So thank you so much for your presentation. I just wanted to understand, you said one of the drivers of cost in the home insurance market was population growth, and I just want to understand why. Is that because of where people are moving into floodplains, or is it because the cost of materials, or why would the population growth itself cause higher
It just
costs?
means that there's a larger area of risk. And yes, what's been happening lately is that people have been moving more towards the coastal areas, which is an area where there's increased expecting losses in those areas. So you're seeing a big growth, let's say, for the Eastern Shore. I'm sure you're all aware of it. And for some reason, people love moving close to the water, and that just makes you a greater hazard for hurricanes.
Thank you.
And if there's any questions that you asked before that you wanted to ask again, I'm willing to answer those tough questions as well. So.
Thank you.
Delegate Woods?
I'm good, thank you. My question is because.
You said Linda.
I mean Nancy, please, and you nodded your head.
You know what? I couldn't hear you, so you're good.
I'm so sorry. Thank you, Nancy. My question is this. There seems to be a pattern of insurance, I'm talking about motor vehicle, insurance increases for residents who live in areas that have more accidents. Is that a fact?
Could you say that they're raising because?
Because there are more accidents in that. In my district, the car insurance is much higher in the area I live in District 26, because we have Route 210, Indian Head Highway. And I want to understand why that is, because a lot of times those accidents are not even caused by people who live in that district.
Insurance companies rate on where you live. Now, for example, I live in Baltimore City. And yes, people drive through Baltimore City to get to work, and they drive out of Baltimore City. Mm-hmm. At the same time, there's a lot of people that, for example, me, I'm driving down to Annapolis, and I may have an accident here. Mm-hmm. But it's based on where I am. And it's just densely populated areas have a tendency not to just have accidents, but they're more likely to have car thefts. They're more likely to have hit-and-run vehicles that are parked. There's a lot of other contributing factors when you're in a densely populated area. But yes, it is based on where you live, not on where the accident occurred.
But what I'm saying to you is where we live, many of the accidents that occur are not occurring because of the residents who live in our district. There are people who are driving through our district, but our insurance is increasing. I'm trying to understand that.
Well, I don't think that's increasing because people are having accidents in your area. They're basing their losses on losses specific to your area. So, for example, we keep talking about this. I live in Baltimore City, and I live in Baltimore City where our rates are higher. That's because I chose to live there, and it's densely populated. So when I drive through Baltimore City, and I've lived there for a long time. When I was younger, I actually drove a beat-up car when I was visiting different businesses throughout the city, because I didn't want someone to think I had a good-looking car. And you know why? I was afraid I would have my car stolen. And I always try to buy a car that isn't likely to be stolen. I know that's silly, but I'm older and I get a little nervous about that. But, car thefts were higher in Baltimore City than they were in other areas. And that has nothing to do, that's what happens, that people in Baltimore City were tending to have their cars more stolen than people that may have been living in rural areas where their cars were not so readily available to be stolen, I guess. That's a correct statement. I hope that provides some clarity. I know that that's a question that always goes through a lot of people's mind. Why am I charged for where I live versus where accidents occur? So.
Thank you.
And if I find out more detailed information, I will definitely send that over to you. I know that's a question that we've heard several times, and I think some other people asked that, so.
Thank you so much, Nancy.
Thank you. So the moral of the story is not to move near the coast, but to move in more rural area.
I know. And that's what I say. I always say, like, oh my God, I'm the perfect example, we pay higher premium taxes, we pay higher property taxes.
Right.
And yet I still don't move, so anyway.
Okay,
So,
well,
really,
thank you.
My name and number is there. If you need more information, Delegate Davis, we have a whole wealth of information about credit scoring and what we've seen in other states. 3 states ban the use of credit. The rest of the states permit it. We do have an example in Washington State where the regulator tried to put a bill in to ban credit for auto insurance, and it failed by the General Assembly there. But then he decided to do it by regulation, even though his bill failed, and he made the insurance companies rate based on credit. And they saw, I think it was 61% of the rates in the state went up because of that. And I think, I might be wrong, but I can get you more details. I think 20% saw no difference, but the rest of the population, about 20%, did see a rate increase. So any other questions?
Great.
Happy to help you.
Okay, well, thank you. If you could provide the information on that last statement, that would be great.
Definitely.
Okay.
And you asked about Virginia.
Well, you know what, Nancy, let them ask you directly.
Sorry, I know, I forgot.
It's fine. It's just that we've got bill hearings after this as well.
And there is legislation to deal with those issues that you're talking about currently going on in JPR right now, to talk to issues about those people state jumping. So anyway, thank
Okay,
you.
great.
Thank you all so much.
I think
and
Delegate
look forward
Cardin is
to working
familiar
with
with
you.
it because it's his bill. Okay, great. Thank you again. And we're going to now move to the National Association of Mutual Insurance Companies. And they're going to, we have one member, yes, and she's going to speak for 15 minutes, and then we'll have questions. We'll give you a few seconds to set up.
All right. Can y'all hear me okay?
You don't have to, just give us 1 second. We're going to turn on your mic for you. There you go.
Thank you. Good afternoon, Madam Chair, Madam Vice Chair, members of House Judiciary Committee. Thank you for the opportunity to speak today. My name is Gina Rotuno, and I serve as the Regional Vice President on behalf of the National Association of Mutual Insurance Companies, otherwise known as NAMIC. I unfortunately do not have as illustrious of a career as many of my counterparts. I just finished up my first year at NAMIC, but I'm so excited to meet each and every one of you and looking forward to working together this legislative session. Today, I'd like to walk y'all through a high-level overview of Maryland's property and casualty insurance market, how it works, the pressure it's facing, and what policymakers should know. Just a little bit about us. NAMIC represents more than 1,300 property and casualty insurers across the United States, including many companies actively writing coverage here in Maryland. Our members write the majority of auto and homeowners insurance nationally and include 6 of the top 10 P&C insurers. And we represent some of the largest carriers as well as some of the smallest carriers. Most importantly, these are companies with deep, long-term commitments to the communities that they serve. At its core, insurance is a financial tool that helps individuals and businesses manage risk. Policyholders pay a premium, and in return, insurers agree to cover specific losses as outlined in the policy. Insurance works because of risk pooling. We all pay into the system so that a few who experience a covered loss can be made whole. Two important concepts here are underwriting and rate making. Underwriting determines whether and under what terms a policy is offered. Rate making determines the price. Insurers use a wide range of different factors to identify wide range of data to identify different rating factors. It's important to note that all these ratings must be non-discriminatory, objective, actuarially sound, and statistically proven to correlate with expected losses and expenses. Another critical concept is solvency. I know we touched on it a little bit earlier. It's the ability of an insurer to pay claims when losses occur. Solvency is crucial for insurance companies because it ensures that they have sufficient financial resources to meet their long-term obligations to policyholders. Unlike other businesses, insurers collect premiums today in exchange for claims that may not arise until far in the future. So maintaining strong capital reserves safeguards their ability to pay these claims when needed. Adequate solvency also protects consumers, supports market stability, and upholds regulatory confidence. These are all factors essential to preventing insurer failures that could disrupt entire financial systems. Property and casualty insurance includes both personal lines like auto and homeowners and commercial lines such as workers' comp and general liability. In Maryland, the MIA plays a central role in ensuring consumer protection and market stability by reviewing these rates to ensure that they are not inadequate, excessive, or unfair. Property insurance covers physical assets, homes, buildings, personal property, while casualty insurance covers liability when someone legally is responsible for injury or damage. For businesses, casualty insurance also covers legal defense costs, which are increasingly significant in today's environment. Together, these coverages form the backbone of financial protection for households and employers. So why is property and casualty insurance important to your constituents? P&C insurance enables recovery after disasters, keeps businesses operating, and provides financial certainty when the unexpected happens. Certain coverages like auto liability and workers' comp are legally required, making market stability especially important. When insurance markets become stressed, consumers ultimately feel the effects through reduced availability, higher costs, or fewer options. How premiums are determined, premiums reflect risk. For property insurance, that includes location, construction type, age of the structure, and proximity to fire protection. For casualty, it includes business operations, claims history, and coverage limits. Mitigation efforts such as security systems or higher deductibles can reduce premiums. This reinforces the link between risk reduction and affordability. So now that we've covered the fundamentals, I just want to discuss the current state of today's insurance market. Today's market is facing a new era of risk. Weather volatility is driving record catastrophe losses. We've seen an increase across the United States in both severity and frequency of major weather events, such as wildfires and hurricanes. I was born and raised in Florida. I can tell you just the devastation that hurricanes have had on the coastline. And we've talked about it a little bit before, I know in the previous ones, but home hardening and how important it is and key. Legal system abuse, including third-party litigation funding and aggressive advertising, is adding friction and unpredictability. Litigation trends are driving costs of claims higher and higher. We've also seen regulatory shifts at the federal level, challenging the long-standing state-based insurance framework. This is really just a slide. I know we talked a lot about inflation today, but really just to show the overall inflation landscape since 2020 here in the US. Inflation has driven up costs on things such as car parts, home building materials, et cetera. Inflation combined with, we saw a pretty significant shortage of both skilled labor as well as auto parts coming out of the pandemic. So it meant that repairs take longer and that cost more. Bad weather and inflation drive losses. While there's a significant peak inflation in 22 and 23, the good news, it looks like it is stabilizing. We're praying that overall inflation stays relatively stable in 26 after dipping early in the year in 2025 and then inching up. And this was talked a little bit before, but these pressures are compounded by population migration trends. In the past 50 years alone, coastal areas have experienced over 250% growth, while the central US has seen population decline. In many cases, people are moving into the highest risk areas for natural disasters, increasing both exposure and loss potential. Excessive litigation imposed real costs on consumers and the economy. The US tort system costs nearly $368 billion annually and equates to a tort tax of more than $1,600 per person each year. For insurance markets, practices like phantom damages, excessive jury awards, third-party litigation funding, and unchecked advertising all increase claim costs, costs that ultimately flow back to the policyholders. All of these added pressures, such as weather, inflation, higher litigation costs, supply chain issues, have driven up prices. A key to understanding insurance market health is the combined ratio. A ratio under 100 means premiums covered losses. Over 100 means insurers paid out more than they took in. Combined ratios reflect underwriting profitability. They enable like-for-like comparisons. They show pricing adequacy over time. They indicate the health of the overall market, and they show different financial pressures. Importantly, the combined ratio does not measure affordability, consumer pricing, or overall profitability. It simply tells us whether underwriting was sustainable. All right, so let's take a look at homeowners insurance in Maryland. Throughout the last decade, both in Maryland and countrywide, homeowners has generally operated at a loss for insurers. In 6 of the last 10 years, combined ratios did exceed 100, meaning insurers paid out more than they collected. I share this to dispel a myth. I think that insurance companies are somehow making excess profits off of premiums. The reality is insurance companies often lose money and are just trying to make people whole after disaster strikes. This is even over longer periods, 3, 5, and 7 years, the combined ratios remain above 100. This means that even with several years of combined ratios below 100, companies insuring homeowners in Maryland have not seen long-term positive underwriting performance. Personal auto follows a pretty similar pattern with volatility year to year. The dip in 2020 reflects reduced driving during COVID, as was touched upon before, but losses returned as activity normalized. As touched upon earlier, the increased cost to repair cars has driven prices up. We saw, again, a pretty significant labor shortage as well as a parts shortage emerge from the pandemic. I think a lot of people know that the cars that we're driving today are really different than the cars that we were driving 20 years ago, and it's kind of like driving a computer now. So the repairs just cost so much more. The time it takes to repair a car costs so much more than it used to, after an accident. A longer view is more positive for personal auto. While the 3-year look shows an underwriting loss, both the 5-year and 10-year performances are slightly under 100. All right, so I just want to wrap up. I want to reiterate that Maryland's property and casualty insurance market is under strain from a lot of different factors, including rising loss costs, legal system issues, shifting risk exposure, and weather pressures. Maintaining a stable and competitive market requires policies that support actuarially sound pricing, reduce system friction, and avoid compounding existing challenges. NAMIC and our members remain committed to working collaboratively with all of y'all to protect consumers and ensure long-term availability and affordability of coverage. I'm happy to take any questions. I know we may be pressed for time, so I'm also happy to take any questions afterwards as well, and I'll stick around.
Thank you, Ms. Rotuno.
Yes.
Thank you very much. I appreciate you coming in, and I appreciate the expediency of your briefing. Members, do we have any questions? Okay, so I'm going to start with Delegate McComas and then Delegate Cardin.
Just briefly, I wondered if you have a list of how you rate the automobile of all the states, you know, who's the most expensive, the less expensive, and then for the property insurance as well. So for auto and property, and that's my question.
Sure, that's a great question. I don't have it on me on hand, but I definitely know I can get that to you. So I'm happy to send it over as soon as we end this. Absolutely.
Madam Chair, I'm gonna pass.
Well, then your neighbor has a question. Delegate Phillips.
I do, and I want to make sure I understand, because the insurance business is more than just underwriting losses. So while there may be underwriting losses, can you tell us how insurance companies actually do make their money?
Sure.
Talk to me about float and, because I might lose money, but I might make a lot. so.
Right. The majority way that insurance companies are able to make money is when you do have that profitability from premiums. A lot of them invest it into stocks and other financial bonds that are very similar, or sorry, mostly into bonds, but other financial entities that are very similar to that. That is the majority of the way that insurance companies are actually able to make money. The most time on premiums, they lose money, and that's something we see consistently state to state. So for the majority, it is actually investments.
I'm sorry, I got distracted over here by my good friend with ADHD. That was Brett Fondling, Delegate, Brett Fondling.
Happens to be the truth.
So I just want to be clear. And while we talk about underwriting losses, that is actually part of the industry's business model. Is that a fair statement?
It is a fair statement, right? It is a fair statement. Insurance companies, we talked a little bit about the importance of solvency, and so they have to kind of almost think about it in long-term risk that they would be losing in premiums, and that it is a lot of different factors that go into the overhead costs and things, administrative costs, but it is something that is factored into. But saying overall that they're losing premiums doesn't mean that these insurance carriers are in the red, if that makes sense.
Thank you.
Thank you for that question, Delegate Phillips, because I was really getting worried. Okay, I think that is all. That was our last question of the day, and I thank you for being here. That concludes our briefing on property and casualty insurance industry. We are going to recess for 15 minutes, and we'll come back and start our bill hearings, which will probably be about 3 o'clock. Thank you.